Hello and welcome to this week's episode of Build Value by Choice. I am your host, Nana Bonsu, President and CEO of Infinite Horizons Incorporated. I have an encore episode with Brian Trczynski. Brian is the Director of Business Market Development at Mass Mutual Insurance Company. Welcome to the show, Brian.
Hey, glad to be here. Thanks for having me.
Great. So we had a great episode the last time. As always, you brought the energy, and you talked to us about how the income replacement value is good for the business owner to know, because that essentially gives the business owner a reference point to shoot for. Otherwise, it becomes like guesswork, like some kind of the way I've heard you put it before. It may not have been the last episode, but previously about a country club, thing where it's like my buddy sold his or her company for this, and therefore mine is worth that. That kind of thing. It doesn't, work out that way. But and then of course, let's just say that you get your wealth management advisor or your financial advisor to give you the income replacement value. It's not like you go to your broker or your certified valuability advisor or your certified exit plan advisor or your certified valuation analyst, right? Because different people use different valuation methods. So let's just say that in our case, we use market value to evaluate companies. Now there's a gap, right? Your business doesn't have enough value to meet your income replacement needs. So how do you do that? You need to build enough, based on the options that we talked about. Building value in your business is probably your best bet, because it's for chances that you probably have grown your portfolio or your net worth in the business to be worth probably like 80 to 90% of your worth based on the survey from Exit Planning Institute. So the basic step that, where we left off from the last episode was, now let's talk about how do you manage your risk, right? Because now we know that your business is the biggest chunk of your net worth. And so the question is, how do you protect your business? And so that's what this week's episode is about. And I'm glad to have Brian back to talk about it. So Brian, I want to start off by talking to you about, and then as we go along, I'll share some metrics and statistics that I pulled, both from your Mass Mutual Business Perspective study and also from the Exit Planning Institute surveys that I've seen. There are a few factors that business owners, as far as when it comes to risk, right? There's the personal risk, there's the financial risk, there's the business risk. What are some of the key risks that business owners need to de-risk their business for? And then we talk about the scenarios as far as depending on which scenario, what risk de-risking methodology makes sense.
Sure. So Nana, let's remind folks kind of what the correlation between these two topics is, right? If you remember in our last episode, when there's that income replacement gap, there's really three ways to address it, right? We can address it by growing the value of the business. We can address it by growing the value of assets outside the business, or we can adjust our lifestyle. And I think you're right. I think growing the value of the business is always going to be, part of that process. But in many instances, it can be a combination of all of them. But, understanding that, most businesses have a value gap. In other words, they're not operating best in class relative to their industry peers. There's probably value that they're leaving on the table because there's things happening operationally inside their business or other things that they can improve that will ultimately grow the value of the business. But before a business owner should embark on a strategy to do that, they've got to protect what they've already built. And we tell folks that, we tell business owners all the time, before you can grow, you've got to protect. Because the investment of time and energy and money that you put into growing your business isn't going to be fully realized if there's significant risks that are evident in your business. And we categorize sort of that risk picture into four areas. The first area is business risk. And that includes things like, continuity planning, buy-sell planning, key employee protection, those types of things that can really impact the business should something unexpected happen. But we also can't forget about personal risk and family risk. So that's things like succession planning and successor development planning and income replacement planning. So we also have to make sure that the family and the owner is protected. And then we've got to protect the future. And that's a lot about what we talked about in our last episode, right? That's the future income. That's the retirement income. That's the income replacement, all those things that we talked about. That's the exit options, the exit strategies, right? That's the future of the business and protecting that. And then finally, we got to protect our team, right? We've got to have key employee protection and key employee benefit strategies in place. And whatever requires to make sure that those employees and those management teams that are so vital to the success of the business are taken care of. And one thing, I'm sure I'm preaching to the choir to you on this, Nana, but the challenge oftentimes with business owners in addressing risk is if we make that process too daunting, too complex, too time consuming, they do nothing. Right. So our job is to tackle this in bite-sized chunks and figure out where the biggest areas of risk are, whether it's in the business, the future, the personal, the team, and attack those first. And do it in a systematized, in a non-complicated and an attainable way for the business owner. And I'm sure we're going to get into what some of those solutions are as we go through the podcast. But I think that's a real good way to sort of set the stage when we're talking about risk and all the areas the owner has to look at.
That's great. Thanks. One thing that I wanted to kind of bring forth is just this idea of the multiple, right? And how the risk affects the multiple. So let's just say that, so if you can just kind of help us again, kind of walk through, because the last time you explained what a multiple is, but I want to kind of expand on that based on the risk profile, how that, impacts the multiple and why de-risking is so important. So if you have a risky business perceived by, say, an external buyer, even if you're not looking to sell, at least you use that as a way to assess how your business is worth in the marketplace. If your business is risky and therefore is discounted by 50%, versus if you de-risk it and you're able to bring it down to, say, 15% discount rate, right? That, in dollar terms, over like a 5 to 10 year period for your for the net present value of your business, that's a lot of money that is basically built in, even if you don't embark on some kind of value building or value acceleration, implementation. Just de-risking alone, the kind of impact that will have on the multiple and the value of your business is huge.
Oh, absolutely. Because we've got to look at this from the perspective of the acquirer. Mm-hmm. And someone's going to come in and make you an offer on your business. They want as little risk to be evident in that business as possible, right? Because what makes a business attractive, what makes a business transferable, what makes a business sellable is its ability to generate future income and profits. And if an acquirer comes in there and sees all these risks, like, for example, an owner-dependent business, not having sticky clients and customers, having the owner be the sales and marketing arm, not having diverse suppliers, products, and customers, right? Those kinds of, that creates risk in the mind of the acquirer. And a business that, as you say, may have a market value or an asset value, of $10 million, once the acquirer or the potential buyer starts thinking about all these risks, we start to see that number get lower and lower and lower, because they have to make sure that, they're covering themselves should any of these risks that they're finding in the business become evident when they take over the business. So, a de-risking strategy is really about minimizing risk, not just for the owner, but also minimizing risk for any future transaction or any future sale. Because I think I don't know if we shared this in the last episode or not, Nana, but we know the statistics around businesses that get put up for sale. And I think the Exit Planning Institute says only about 20% of them ever actually transact. And even of the ones that do transact, half of them are going to transact at a price and terms that were below what the current owner originally expected. And a lot of that stems from the fact that when they're going through the due diligence process, they're going through the M&A process, risks are uncovered, and that's impacting the sale price, and that's impacting the terms. So there's so many reasons why risk has to be addressed, both for today and also for the future of the business.
Yeah, I mean that is, and that's why I believe it was also the Exit Plan Institute survey. It may have been the 2013 one or maybe the 2018 one that I saw, where like 1 year after owners exit, about 70%, 75%, 3 out of 4 actually have regrets. And
Hmm.
some of it probably has to do with some of these risks that, maybe some may have been too focused on the income that's coming from the business and the lifestyle that it supports, that they didn't pay enough attention to the de-risk and some of the de-risking strategies that you've talked about briefly, that that we're going to get into some more in the course of the show. Um, I I wanted to two things. One was I wanted to talk about this. So how does the mindset shift between a lifestyle based business, because the last time you talked about the lifestyle and the value business, right? Where the lifestyle business owner essentially takes income from the business and support their lifestyle, rewards points. And he gives an example of one family that was using up, didn't pay out of pocket for their vacations for a long time, and they were worried about how they were going to all of a sudden fund that. So versus somebody that's a business owner who's changed their mindset to look at their business as an asset, and therefore any asset needs to be has a risk profile that needs to be managed. Can you tell us, just the de-risking, how that how mindset plays into the whole de-risking process?
Yeah. So when a business owner comes to the conclusion or gets to the point where they realize that their business is an asset that at some point in time they need to monetize, because remember, a business is an illiquid asset. And the goal of the business owner has to be to turn that illiquid asset into something that they can monetize when they're ready to exit. And that means making it an asset that's transferable and sellable. And and unfortunately, a lot of business owners um, don't correlate the two. And there's really two pieces of information, two pieces of data that a business owner needs to understand to determine, um, as what we call, business owners can be one of two things. They can be, business rich, cash accessible, or they could be business rich, cash poor, right? In other words, they've got a business that's generating great current income, but they're not going to be able to monetize that when they exit, as opposed to the business owner that is generating great current income, and they've built something that they're going to be able to transfer someday that will continue to generate income. And the two factors that really go into that are, number one, their chosen exit strategy. Right? I mean, if you've got a business owner that is going to be heavily reliant on the business to fund their future income in retirement, et cetera, gifting the business to the children probably isn't the right exit strategy, right? The other factor that gets overlaid into that is their multiple, and or their, and there's a lot of tools out there that'll sort of pinpoint, we know, I think we talked about this a little bit on the last podcast, but we know that within any given industry, there's a normalized trading range, right? So for example, if you're a manufacturing business, you're going to transact at between 3 or 7 times your EBITDA, right? And what we need to understand is, what does your business look like underneath the hood? Are you best in class and could potentially transact at 7 times? Or do you have some deficiencies in your business and you're going to transact at 3 times? And understanding where your business falls on that bell curve, on that normalized trading range, coupled with your chosen exit strategy, that's how you can really start to determine what's the likelihood of you being able to fully monetize this business. But again, getting back to your question about risk, if you have a lot of risk evident in your business, then most likely you're going to transact at the lower end of that trading range. So risk plays a factor in all of those things. And de-risking the business is just one way that you can ensure that your business is going to be sort of best in class in your industry, and ultimately trade at its highest possible multiple.
That's great. I wanted to ask you about size and the correlation to perceived risk from, say, an acquirer or a hypothetical acquirer if you're not looking to sell anytime soon. Now, from a logical perspective, the bigger your company, the less risk a perceived buyer in general. It's just, there's always exceptions. just because it's perceived that if you have a bigger company, chances that you have like a management team in place and other factors in place that help mitigate structural risk. How does a business owner who may not be interested in scaling de-risk, given the factors of the bigger the size in general, based on some metrics and statistics that are out there, that bigger companies tend to, if on average companies command, say, 3 times EBITDA or 3 times multiple, the bigger companies could garner maybe the high 4s and the 5s and the 6s in terms of multiple. Can you just explain in terms of the what attitude or mindset around size and whether or not scaling should be part of the de-risking strategy or not?
You mean is building a bigger business one way to
and putting the foundations in place as part of your de-risking, because making it bigger is part of growth, which we're not talking about in this episode at least. But it's just from a risk perspective, I'm just talking about the valuation, the perceived risk from a buyer perspective, who perceives bigger companies to be less risky, right, than smaller companies. So I'm just kind of looking at the risk angle from a smaller company versus a bigger company.
Yeah, I mean, listen, everything's relative. I mean, I've never actually seen that data. So I can't comment on whether it's accurate or not, but I don't necessarily believe that, if you're a bigger company, that you're automatically going to be perceived as less risky. I mean, I think that there's certain things that, acquirers
I'm talking about for privately held companies, so just that caveat, not
yeah,
public,
no, I get it. I'm not sure I'm going to answer this question the way you want me to, but I think this is an important point.
Yeah.
Because I've like I said, I've never seen that correlation, but I think it's important to understand what adds value to a business, what's sort of neutral, sort of the table stakes, and what detracts value. Right. And I really think that this is regardless of size, right? Because if I'm looking at a business as an acquirer, there's certain things that a business should have or has that are going to make me, want to increase that multiple. Obviously, it's things like the ability to grow. Like if they've capped out their growth, that's going to impact how I view them, right? They've got to have a dominant market share. They have to have a reoccurring revenue model. There have to be difficult barriers to entry for other competitors. They have to have product differentiation, and they've got to have a strong brand. A business, regardless of their size, if they have those things in place, they're going to be viewed as very attractive to an acquirer, and that's going to enhance their value / their multiple. There's a couple of things, Nana, that are sort of value neutral. Like when an acquirer comes in, these are the things that they expect to see. That's having strong sales and marketing. That's having good customer satisfaction, and that's having the ability to attract and retain employees, right? Those are kind of the table stakes things. And then there's the things that really will detract value. So in other words, if someone comes into the business and analyzes it for sale, if there's no senior management team in place, if their customers aren't diverse, in other words, they're very reliant on 1 or 2 key customers, and if they left, it's going to be an issue. Obviously, their legal, their financial, and their operations have to be in order. And the potential market is not large enough, right? That kind of gets back to the growth thing. I mean, generally, Nana, if that's kind of how I think we should look at these things. I don't necessarily, and it's all relative, because a smaller business, if they have those things in place, will be viewed as just as less risky, as the bigger company that has those things in place. And I would argue too that if a smaller business has all those things in place, and a bigger business has half of those things in place, I still think that the smaller business is going to do better in a transaction.
Yeah. It's all about the value drivers. Yeah. So on the last episode, you had mentioned about 6 exit options that a business owner have, 3 internal and 3 external. I wanted, if you may, just kind of walk us through, like, if you look at it as a matrix and some kind of spectrum, just how each option, if an owner were to force to say liquidate or to sell to third party, in that range, what are the de-risking, corresponding de-risking methodologies or strategies against each of those options?
Yeah, I mean, let me even start even a little bit higher than that. There's certain things that every business owner has to have in place from a de-risking strategy, regardless of what their chosen exit strategy is. If there are multiple owners, there has to be a buy-sell agreement in place between the owners. If for those of you who don't know what a buy-sell agreement is, that's a legal document that stipulates that when some sort of triggering event happens, usually death, disability, divorce, an owner leaves for some reason or another, or whatever, something like that occurs in the business, that document will stipulate the terms under which the remaining owner will buy out that owner's share, either from their heirs or from the owner themselves. And that has to be in place, because God forbid something happened to one of the owners. The last thing the remaining owner wants to do is be in business with the surviving heirs of that owner, who may have no interest or no knowledge of how to run the business. These documents have to be signed. These documents have to be funded, and they really should be funded with insurance products, because again, the last thing you want to have to do is liquidate business assets to fund that buyout. So that's number one. The other thing that business owners have to have, regardless of their exit strategy, is key employee protection and key employee benefits, right? Because as we talked about both in the last podcast as well as in this one, your management team and your employees are vital to the future success of your business. So you've got to make sure that, again, God forbid something happened to one of those key employees and they left your business for any reason, you have the ability to keep the business going as well as find a replacement key employee, and you need the funding to do that. Same thing on the benefit side, right? The benefit landscape has changed. The benefit package that you put in place 30 years ago may not be the same benefits that employees want today. So constantly reviewing these and making sure things that you're offering, whether it be, health insurance, retirement savings plans, supplemental disability insurance, supplemental life insurance, non-qualified deferred compensation plans, all these there's so many things that you can do to incentivize your employees, and many of them can also help you as the owner save for your future retirement as well. Should always be reviewed. So those things have to be in place. But in terms of, Nana, getting back to your question about the different exit strategies and how they impact it, I think, if your goal is to create a legacy for your family and you're going to gift the business to your children, you've got to have assets outside the business, right? Because you're going to create a non-cash transfer of that business, and you want to make sure that on the personal side, you're taken care of. And everybody always throws this statistic out there, Nan. I'm sure you've heard it a million times.
Yeah.
That 30% of businesses don't survive past the second generation. And we are always so quick to say, well, it's because the next generation of children didn't know how to run the business and they ran it into the ground. And everybody's always so quick to blame the next generation for that statistic. I go on record all the time in saying, while there may be some truth to that, I believe that the real reason why 30% of businesses don't make it through the second generation is because the current owners, the parents, gave them an asset that wasn't ready to transfer. And the children were set up to fail because they created a business. You got to view it like you're going to sell it. Even though you're gifting it, you still have to take the same approach. You're still creating a transferable asset. And just because you're gifting it instead of selling it doesn't mean that you shouldn't have all those same de-risking strategies in place. Make it easier for your kids. And I guarantee that statistic will change. So, I'm a firm believer in making sure that even if you're gifting the business, which isn't always the right exit strategy, but that could be another podcast. You got to make sure that you're still creating a transferable asset. Same thing, if you're going to do some kind of inside buyout where a co-owner or a key employee is going to buy the business, again, chances are, especially if it's a key employee, they're not going to have cash to buy you out in one lump sum. You're going to have to do some kind of installment buyout. You're going to have to take back paper, something like that, because they're not going to have the bulk of cash. So again, you've got to make sure that you've got protections outside the business. You can't be reliant on how well that key employee runs your business. to fund your retirement. So that's another thing to keep in mind. And Nana, an unfortunate, sad statistic is sometimes great key employees don't make good entrepreneurs.
Oh yeah.
And I think it's a sad reality that owners need to recognize that they regardless of the exit strategy they're chosen, whether it's selling it to a key employee, gifting it, they've got to make sure that they've got those assets outside the business. Should something unfortunate happen and the business doesn't continue to be successful when they step away.
Yeah, the whole left brain, right brain thing. So I'm going to go into lightning round.
Okay.
How do we de-risk against owner dependency? Because you did mention about that, the owner in terms of owner death, departure, disability. Because you did mention disability as more, I think it was a previous episode. Disability is actually more frequent than death, and folks usually don't plan for that. So how do we de-risk against owner dependency?
Yeah, owners have to go into this saying to themselves, my job, my role is to make myself as redundant in this business as possible as soon as I can, right? And that
what
means
if it's my baby? What if I'm the owner? That's all I know. I don't have life outside the business.
That's not an excuse. Listen, it can still be your baby and it can still be your life, but but you can still have a number two who can run the business and knows all the things that you know. You can't, business owners want to do everything. They want to control everything. They want to know everything. That does not create a transferable business. It also creates issues for the business if the owner dies or becomes disabled or something unfortunate happens like that. There needs to be somebody that can step in, that can run the business at least close as close as well as the owner did. And that creates that's how you create a business that's not owner dependent. Owners have to be willing to delegate and share responsibilities and train people to do what they do.
How do you de-risk against supply chain risk? We know there's a lot of supply chain disruptions and supply chain issues going on right now. How do you de-risk against supplier concentration and supply chain issues?
Yeah, I mean, we talked about this. Diversification is huge, and it's not just with suppliers. It's with customers. It's with vendors. It's with products and services. Diversification is probably one of the most important things a business owner has to understand. You cannot be reliant on one or two suppliers. You cannot be reliant on one or two customers, and you cannot be reliant on one or two products or services. Because like you said, it's something like we're dealing with right now where there's supply chain issues or a customer decides that they're going to go to the competitor. You have to make sure that you can weather the storm of losing one of those suppliers, customers, et cetera. If you got all your eggs in just one basket, one supplier basket, one customer basket, that is not going to be viewed favorably by someone who's looking to acquire your business. You have to diversify in all those areas.
How do you de-risk against labor shortages and key employee dependency?
Well, a key employee dependency is a good thing, right? We should be dependent upon our key employees, right? That's getting back to that whole not being, owner dependent when you're key employee dependent. But labor shortages, I got to be honest with you, that's not really my area of expertise. All I can really tell you in that arena is that you want to make sure that you're the employer of choice in your given industry, and it really all gets back to having good benefit plans, having having good work environment, having a good culture, having a business that people can rally behind and get behind and want to be a part of, your mission. Like that's very important to employees these days. So just making sure that when you're out there trying to recruit and attract good talent, you've got a good story to tell about your business, and you can offer them the ability to grow professionally, protect their family, safe for the future. Those are the kinds of things that are going to help you sort of be the employer of choice as you're looking to enhance staff and attract key employees.
How do you de-risk against inconsistent revenue? Because you could have like COVID, or you can have some global systemic financial crisis from 2008. I'm sure there's probably going to be another one coming. And so if somebody were looking at the trailing 3-year revenue cycle, chances are, business owners' revenue probably took a hit last year. But some owners did well. Some owners, their revenue either went up or at least was staying relatively close to the same. So how do you de-risk against inconsistent revenues due to macroeconomic and global issues?
Well, even more basic than that, Nana. I mean, some businesses, you have the seasonality of businesses, right? I mean, we don't even have to look at it from, global pandemics to just look at, these businesses that have seasonal revenue, and there's two ways that business owners have to look at. They have to protect themselves personally, financially, and then of course they have to, create, transferability for if they go to sell. So when you're dealing with these businesses that have, seasonal revenue or have to deal with things that impact their income on the personal side, though, you have to have that emergency fund. We're revamping our study that you've referenced many of the statistics from, and we're revamping it as we speak. And we've talked to a lot of business owners already, and they tell us that if it wasn't for the savings that they've been putting away, the emergency funds that they build, 6 months, 12 months of emergency funds, they wouldn't be able to weather, the storm. They wouldn't be able to continue. So on the personal side, having that emergency fund, at least 6 months, 12 is best, of cash that you can draw on to get through those issues. But when you're running a seasonal business and you having, that all again gets back to diversification of product and services. What can you do in those down seasons to generate revenue? Maybe it's not going to be as much revenue as you're generating during your high season, but is there something you can offer to your customer base during those slower seasons that at least keep the revenue kind of going in, right? Because you're going to make your big influx of income and revenue during the summer, per se. But what can you do in the winter so you're not depleting all of that you built up during the summer? So having those thoughts about diversification again on the products and services side is beneficial both on the personal, but also in terms of making your business more transferable.
What is the best case and the worst case scenario for a business owner when it comes to risk?
That you don't have any. No, I mean, in all seriousness, there's always going to be risk. That's evident. We can't solve for every risk that's out there. It's foolish to think that we can. But the best thing that we can do is make sure that we're covering ourselves from the most common. Whether that be, and the five that we talk about, the 5 Ds. Everybody has their versions of the 5 Ds. Our version of the 5 Ds are death, disability, divorce, departure, and disqualification, right? So making sure that those are covered. So God forbid something unfortunate happens to an owner or to a key employee, there's a plan in place to keep the business going. We can't control the macroeconomics, as you were talking about. We can't control that, right? We can't control competition coming into the market. We just have to be ready that when those things do happen, whether it's setting up emergency funds, whether it's diversifying our customers, our products, and our suppliers, doing those things, not being owner dependent, just making sure that we have those plans in place for when those things happen. And really, Nana, the only way business owners can do that is by doing a full assessment of their business. Right? A business owner has to go through an exercise with a professional to understand where their risks lie. They shouldn't try to figure it out on their own. There's professionals that do this kind of work that can sit down with the business owner, take them through questionnaires, take them through fact finding to uncover where their exposure is. And then the business owner can take that information and build a strategic action plan to address those issues and de-risk those 4 areas I talked about at the outset as much as they possibly can.
Final question. What are the biggest obstacles that prevent owners from de-risking their business?
Themselves. I mean, that one I'm not saying as a joke. That is the truth. It is themselves. And we see this all the time. Business owners, when we approach them with issues of risk, it's always a lack of perceived need. Nah, I don't need to worry about that. It's a lack of time to address it. I'm so focused on what's coming down the pike in my business, I don't have time to address those things. And it's the assumption that these things cost too much money, right? I don't have money to put towards paying for these types of services. But the reality is you can't kick this can down the road because every business owner is going to exit their business either by design or by default. And we can start planning for these issues at any time. And the sooner we do it, the better. But again, I understand, as I said earlier, a lot of professionals, unfortunately, make these things too complicated, too complex, too daunting, and too unattainable for business owners. I get that. And that forces them to do nothing. So I think our accountability in this, Nana, as advisors and professionals, is to make sure that our business owners understand that, yes, you can accomplish this. It's not that complicated. And there are people out there that can help you do it right. And I think if we as a as those professionals that they rely upon for that kind of advice can do a good job of getting that message in front of them, I think we'll start to see more business owners willing to tackle these issues and not be their own worst enemy when it comes to handling risk.
Yeah, I know. I mean, that's a great point. I mean, I think you basically kind of tied a knot on it nicely, and essentially, and if I were to quickly kind of summarize, which is the next steps for business owners, some of the key takeaways is they need to make sure they get evaluation done, some kind of assessment or evaluation done. That will help them uncover some of the risks that they need to create action plans to de-risk against. They need to probably work with a professional advisor, whether it's a certified value builder advisor or a certified exit planning advisor or their wealth management advisor, somebody who can help work with their different advisors, their legal advisor for like buy-sell agreement or some other thing. That way, they have somebody who can shield them or be a buffer for some of the complexities, some of the things that are perceived to be complex, and somebody who just kind of help them navigate through that and kind of work with the other advisors as a team on behalf of the business owner. Are there any other actionable items that or words of wisdom that you can leave our audience with?
Yeah, the other thing I would say to those of you out there that have these agreements and have these documents and have these plans in place, they need to be reviewed and updated at least every 3 years. Just because you did do a buy-sell agreement, 20 years ago when you opened up the business, doesn't mean it's still, accurate and still accounts for all the things that have changed, changes in business value, changes in family relationship, changes in ownership relationships. So I know we've talked a lot about those that don't have these agreements, but even those that do, you have to make sure that you're reviewing them periodically, like I said, at least every 3 years, because we've seen a lot of issues over the years where those documents get pulled out of the filing cabinet and they're stale, they're old, and unfortunately it creates conflict and issues with the remaining owners, with the departing owners, with the families of the departing owners. And the last thing we want to see happen, both when these things happen, listen, they're hard enough as it is. We don't need to create discord in the family, and we don't need to do anything that's going to jeopardize the continuity of the business. So we got to make sure that these documents are up to date and reviewed.
Yeah, no, that's great. And I guess once they've taken all this wisdom that you've shared into consideration and de-risk their business, then they'll be nicely set up for growing value, which we can talk about maybe in a future episode, or maybe you can come back after your study. I know you say you're updating your study. Maybe we can talk about the findings.
Definitely.
So that would be great. Well, thank you so much for your time. And talk to you in the future soon. And thanks everyone for listening. Till next week. Bye-bye.
Thanks. Bye-bye.